Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this Expiration Friday video, rolling in the money call options on or near Expiration Friday. As many of you know, position management or exit strategies is a critical part of successful option selling. Stock selection and option selection are the other two required skills. Now, after we write a covered call, if we find as Expiration Friday is approaching that our strike price is now in the money and we take no action, our shares will be sold the following day, even if the strike is in the money by just a penny. We may not want our shares sold. We may want to retain those shares for the next contract month. This video will go over our choices as it relates to rolling these in the money strike prices. Let's start by defining what rolling a covered call option on or near Expiration Friday is. Well, after we sold the option, if we don't want our shares sold, we buy back that option. On our broker trading form, it will say buy to close or BTC. And then we immediately sell a new option in the next contract month. Okay, so we are rolling the option out to the next contract month. If we were rolling the option in the same contract month, it would be rolling up or rolling down. But we're talking now about on or near Expiration Friday as the contracts are expiring. Now, this applies to in the money strike prices, because if the strike was out of the money, then there would be no need to roll the option. We could just take no action, the option will expire worthless, and then the following week, we could write another option. So, on Expiration Friday, we have two choices if we're going to roll that option. We could roll out to the next month contract, same strike price, or we could roll out and up to the next month's contract at a higher strike price. So when should we consider rolling our in-the-money options? Well, first of all, we want to make sure that the stock, the underlying security, could be an ETF as well, still meets our system requirements. Now, when we screen stocks or ETFs for option selling, we want to make sure they're fundamentally sound. So we look at earnings and sales growth. We look at the price chart of the stock, make sure that it's mixed to bullish. And we also want to make sure that it meets our common sense requirements like minimum trading volume, diversification, cash allocation, but most importantly, avoiding earnings report. If the strike is in the money, chances are the price chart still looks strong. And since we avoid earnings reports, there really isn't that much that can change the stock's fundamentals. So the main thing we look at is there an upcoming earnings report in the next contract month? If there isn't, then rolling is certainly a choice we should consider. We also want to make sure that the calculations meet our initial time value return goal range. Now that means that before we enter the trade and before we consider any exit strategies, we must know what we're seeking to achieve. In my case, my initial time value return goal range is between 2 to 4% for selling near the money 1 month expiration covered calls. In a bull market, I'll go as high as 6%, but never higher. Now, that doesn't mean this should be your range. You may seek lower returns and go more conservatively, or you may want to be more aggressive and seek higher returns. But that's where I stand. So let's have a look now at our rolling out strike possibilities. If you just roll out, then you're always rolling out to an in-the-money strike, because you wouldn't roll unless the strike is in the money at that point in time. As I said before, you could, if it's out of the money, just take no action. The option will expire worthless, and you're good to go the following week to then sell another option. But if you do have a strike in the money and you do close it and then sell the next month's strike prior to expiration of the near-term contracts, well, that strike is still in the money at that point in time. So for example, if a stock is trading at 52 and we had sold the $50 call initially, and we buy it back, and then at that point in time, roll it out to the next month's 50 call, that's rolling out. We're not going up to a higher strike. So as the example on the screenshot, we buy to close the September 50 call and sell to open the October 50 call. That is rolling out. Let's set up a hypothetical trade with stock BCI. Let's assume BCI was trading at $78 a share when the initial covered call trade was executed. And we sold the $80 call option, let's say for $2. That would generate about a 2.5% time value return on the option. That would meet my initial time value return goal range. Now on expiration Friday, look what happened. BCI popped up to 86. It went from 78 to 86, leaving that 80 strike deep in the money, $6 in the money. Now we check and we find there's no upcoming earnings report, so rolling the option is a possibility as long as our other system criteria are met. Specifically, the earnings report is the main one we look at. Now we can evaluate rolling out to the October 80 strike. In other words, we sold the September 80, buy it back, and then sell the October 80. That's rolling out. Or we can evaluate rolling out and up. But look, when we roll out and up, we're not always rolling out and up to an in-the-money strike. It could be an in-the-money strike, or it could be an at-the-money strike, or it could be an out-of-the-money strike. As an example, if we rolled out and up to the 85 strike, even though it's higher than the 80 strike, it's still in the money compared to the current market value of 86. Now, if we roll out and up to the 86 strike, that's precisely what the stock is trading for at that point in time, then it would be an at-the-money strike. Or we can roll out and up to the 88 strike, which is out of the money compared to the current market value of 86. So what resources do we need to do these computations? Well, we have 3 calculators that you could use. We could use the basic element calculator, which has the What Now tab. All 3 of these have the What Now tab for rolling options. That calculator is free on our website. I'll show you how to get it at the end of this video. We have an expanded basic element calculator called the Elite Calculator for covered call writing. That's located in the BCI store. And what I consider our best calculator is the Elite Plus calculator, which you could use for both covered call writing and selling cash secured puts, and have a look at our entire portfolio position in addition to individual positions. So we need the What Now tab of one of these calculators. And then we need information we would gather from an options chain, which is a price list of all the options that pertain to a particular security, in this hypothetical, to BCI. Now, every broker has option chain information, so you really don't need to look any further than your own broker. However, there are free sites that offer this information. The one that I have on this screenshot is www.cboe, which is a free site. You'll just have to click the I agree link, and then you can look for delayed quotes. And it's a very nice site for option chain information because it also gives the Greeks, for those of you who are familiar with the option Greeks and interested in those kind of stats. That's found on this free site as well. So let's have a look now at the strikes that we alluded to before. And we're going to start now with the rolling out. So the information in the blue cells of the What Now tab, the left side of the spreadsheet, are entered. And you could see here that the original option was sold for $2, but is now trading at $6.05. Well, that makes sense because the stock is trading at 86. We're on expiration Friday. The option sold was 80, which is $6 in the money. So $6 plus a few pennies of time value as the contracts are about to expire. So $6.05. Now we have a look. How much is the 80 strike next month rolling out to the same 80 strike? We take a look and we see that it generates $7. Keep in mind, these are hypothetical numbers that will seem to fit, you know, most of the option chains in real life examples. So you could see right away, wait a minute now, we're only making 95 cents because we have a credit of 7 and a debit of 605. So where is that going to leave us? Well, once we feed that information into the what now tab of the Element calculators, then the rolling out information appears. So you can see we have the credit here of $95. Now that's on a cost basis of $80 a share, $8,000 per contract, because that's all our shares are worth at that point in time due to our contract obligation to sell at 80. It's not worth 86. Our shares are worth 80. So if we rolled out, we would then generate a 1.19% 1 month return. Now that annualizes out to about 13%, just to put it in an annual framework there. Now, we also have the benefit of downside protection. In this case, the calculator shows us 7%. That means that we are guaranteed a 1 month return of 1.19% as long as share value does not decline by more than 7%. Or stated differently, does not decline from 86 to below 80. Now, if this return meets your criteria and your goals, then you may want to consider rolling out. It's a very conservative way of generating 1.19% 1 month return with a lot of downside protection. One size doesn't fit all, only you know whether or not this is a right approach for you. Let's move on to the next strike price. In this case, we're going to use the October 85, let me just put it over here, which generated $3. Now, we have a debit of 605 and a credit of 3. So we have a debit of 305, right? But our shares are now worth $5 more. They move from 80 to 85. So we end up with a unrealized credit of $1.95 or $195 for the contract. On a cost basis of 80 or 8,000 per contract, that represents a 2.44% 1 month return. Now the downside protection is lower, it's 1.2%, because now the downside protection is from 86 to 85. So we are guaranteed a 2.44% 1 month return as long as share value does not decline by more than 1.2% or below 85 by contract expiration. Next, let's move on to the next strike price, which is the 86 strike at the money. Here we have cost to close of 605 and we're generating even less, 250. The higher up we go, the lower the premium. So you could see here with the 86 that we have a debit of 355. But what are our shares worth now? Well, our shares now are worth another $6 per share from 80 to 86, 600 per contract. That means that our actual unrealized return is 245. On that same cost basis of 8,000, it represents a 3.06% 1 month return. Now, there's no downside protection of that profit. There's always a break even, but no downside protection. And of course, no upside, because we are agreeing to sell our shares for the same price that they're currently trading. So this would be a good strike if the market was moving flat, because we get a nice juicy 3.06% 1 month return. Now, what if we're more bullish and we take a look at the 88 strike, which generate, yes, a lower time value, going higher, of $1.50. So you can see here we have a cost to close of 605 and a credit of $1.50. That puts us at a debit of 455. But have a look. How much are our shares worth now? Well, they're up $6, just like the at the money. But in addition to that, now we have the upside potential of $2 per share from 86 to 88. So if the price didn't change, we would then have a net credit of 145, which represents a 1.81% 1 month return. Now, if the price of the stock did in fact move up to the 88 strike or higher, that would give us a net return of 345, which now represents a 4.31% 1 month return. So that would be the strike that gives us the highest maximum return. And I would look to this in a bull market where our chart technicals are very strong, all bullish. The overall market is bullish. I would prefer the out of the money 88 strike. So in this case, we're rolling out and up to the 88 out of the money strike. Now, let me just show you where you can get these calculators, and then we'll summarize this video. So you could see here that the basic Elman calculator is located in the free resource section over here. Just click on that and put in your email address, and you can download the basic Elman calculator for covered call writing. We also have a single column put calculator. And I just want to point out another free resource that's very popular is our Beginner's Corner tutorial, which are 2 8-part video tutorials, one on covered call writing, one on selling cash secured puts, and you can download the PowerPoints. All that's free. Now, if you want to get the expanded calculators and lots more books, other video programs, spreadsheets, online mentoring, and so on, just click on that store link over there, and you can enter the store and make your selections. If you're interested in our premium membership where we do the screening for you, this is the link over here. So there's lots of information that will help you master these option selling strategies. Let's summarize this Expiration Friday video. Rolling options apply to in-the-money strikes. Otherwise, there's no need to roll the options. These shares must meet our system criteria and goals in order to make it sensible and appropriate to roll the option as expiration is approaching. Now, we use the What Now tab of the BCI calculators to do these computations for us. Now, if we're rolling out, it's always to an in-the-money strike. And if we roll out and up, it could be to any of the other 3 possibilities: in the money, at the money, and out of the money strikes. So that's where the calculator really comes in handy, because it'll always do these numbers for us, and that will help us make the most appropriate decisions when we are using these exit strategies for covered call writing. So, ladies and gentlemen, there you have it, our Expiration Friday video, where we discuss rolling in the money call options on or near Expiration Friday. Folks, I hope you enjoyed this video, and more importantly, I hope it puts cash in your pocket. As always, this is Alan Elman, the Blue Collar Investor. Take care, everybody.